Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So in the next slide, we focus on what is the support, what is the resistance. It's the basis of technical analysis. A support is a level or area on the chart under the market where buying interest is sufficiently strong to overcome selling pressure. In opposite, resistance is the opposite of support and represents price level or area over the market where selling pressure overcomes buying pressure and the price advance is turned back. Why support and resistance are very important. The purpose of support is to determine intervention level in order to entry long or short position and especially to determine stop loss. In this example, you have a clear support because price bounces off 3 times on a clear level. So when you identify a support, you can enter a long position on the support, and you can determine a clear stop loss. In this example, you will enter a long position close to the support, and the stop will be just under this key support. So that's why you can determine a key entry level, and you can determine a clear trading plan. The importance of the support is identified by the number of rebounds. I mean, more you have rebound on a clear level, more the support will be important. And the importance is also identified by amplitude of rebound. More you have a larger rebound on a key support, more the support will be a key support and will be important, because a lot of traders will see the same support like you, and the stop loss will be consistent. That's it for the support and resistance. We will focus on channels. So we have three kinds of channels. You have the first one on the slide is the ascending channel. The ascending channel is shaped by successive higher peaks and higher lows. The lower boundary of the channel is parallel with the upper boundary of the channel. And the main goal of the channel is to buy close to the lower boundary of the ascending channel, and to sell or take your profit close to the upper boundary of the channel. So the bullish channel is a continuation of the uptrend. The second kind of channel is a range. Prices move back and forth within range boundaries. It's a sideways market. So when it's the same for ascending channel. You buy when we are close to the lower boundary, and you sell, or you take your profit when you are close to the upper boundary. And the third one is a descending channel, bearish channel, which is shaped with successive lower peaks and lows. And the same thing for the other channels. You buy close to the lower boundary and you sell close to the upper boundary. It's a continuation of the downtrend. So another pattern on prices you can see in technical analysis are triangles. We have 3 kinds of triangles. So we have the ascending triangle with the lower boundary. The lower boundary of the ascending triangle is rising while the upper boundary is flat. So the lower boundary is there, the upper boundary is there, okay. In general, an ascending triangle is the consolidation pattern. So, I mean, you have a bullish trend just before the ascending triangle, and the consolidation is shaping within this ascending triangle. And when we have the upside breakout of the ascending triangle, you can determine a target. So the target is determined by the base of the triangle, and this target, for having the target, you report the height of the base from the upside breakout of the ascending triangle. So there, it's a fixed target. For example, if the stock trades at $2 at the lower of the base, and trades at $4 for the upper boundary, the target will be 6. I hope it's clear for all. Because it's simple, 4 plus $2. The second one, triangle, is the symmetrical triangle. The lower boundary is rising while the upper boundary is declining. Like for the first one, like for the ascending triangle, it's a consolidation pattern before the resumption of the trend, okay? So the difference with the ascending triangle is the target, because target is a moving target. It's not a fixed target, because the target will be the parallel of the lower boundary. So the main difference is in the target, moving target. And the third one is the descending triangle. So imagine that we are in the bearish trend. So it's a continuation of the bearish trend. It's a consolidation within the bearish trend, And you can enter a short position when you have downside breakout of the lower boundary, which is flat, in opposite with the ascending triangle, and the target will be a fixed target, like for the ascending triangle. So when you have downside breakout of the lower boundary, means you will have the resumption of the downtrend. So overall, triangle are consolidation pattern within a trend. So you will enter position, or we will enter position when we will see the upside breakout or the downside breakout on the descending triangle. Next. Sorry.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.